Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/rive to receive the top 10 stocks to buy right now. Caesars Entertainment reported first quarter 2023 financial results recently, and it was a really interesting quarter, especially compared to its biggest competitor, MGM Resorts. So that's what I want to dig into is the numbers from Caesars, which were actually really strong, but maybe not quite as good as its biggest competitor. And I want to talk about the dynamics there and how investors should be thinking about that. My name is Travis Hoyam. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content, and let's get into Caesars' first quarter results. I want to start here with segment revenue because this really tells us where Caesars is making its money and where the growth is coming from. So the company splits things up into Las Vegas, regional, Caesars digital, and then managed and branded. I'm going to skip most of the last three here and just focus on Las Vegas and regional markets because that's a vast majority of the company's revenue. Las Vegas revenue, $1.13 billion for the quarter. That was up 24% from a year ago. Regional casinos, $1.4 billion in revenue, up 2%. If we go down here to adjusted EBITDA, that's a proxy for cash flow from these resorts. $533 million, up 33% from a year ago. And regional casinos actually down 2.4% to $448 million. Now, if we go over and look at MGM's results, you can see here that MGM's revenue in Las Vegas grew 31%. Adjusted EBITDA grew 41%. So results were a little bit better at MGM's properties. Regional results kind of similar, up 6% and flat on an adjusted EBITDA basis. So a little bit better than Caesars, but still not outstanding results on the regional side of things, which is probably about what we should expect given the fact that this was really a point of strength during the pandemic, and now it's going to be less of a point of strength as people are traveling more. I want to highlight the balance sheet here as well. Almost $1 billion in cash on the balance sheet, but there's also $13.2 billion of debt. Net debt is $12.2 billion. MGM, on the other hand, has about $7 billion in total debt, and net debt is lower than that. Caesars operations are definitely improving and generating almost $1 billion in quarterly EBITDA is really a positive thing, especially when you consider the company's big debt load. But for investors, the thing we have to think about is risk versus reward. And where's the opportunity? Where's the growth? Right now, what we're seeing is that everybody is growing in Las Vegas. Regional casinos are not growing nearly as much and even shrinking a little bit from an EBITDA perspective or a cash flow perspective. So that puts Caesars in a little bit of a disadvantage to a competitor like MGM Resorts, who has more of its exposure to Las Vegas. Add in the fact that the most significant growth in the quarter is actually not in the US at all, it's in Macau, and Caesars doesn't have any exposure to Macau. So when we think about these two companies, there's a lot of reasons to think that MGM is just simply better positioned operationally than Caesars is. It's better positioned in the US, it's better positioned around the world, and it even has the potential to build a casino in Japan, which is potentially the next big gaming market to open up. So from an investment perspective, Caesars is just a much higher risk with lower reward, I think, than a competitor like MGM right now. That's why between these two stocks, and we should often be comparing these two companies from a valuation perspective, I think that MGM is a much better bet and much better investment. The recent results show exactly why. But what do you think about Caesars and MGM? I'd love to hear your comments in the comment section below. Don't forget to subscribe to Rive Investing. Thanks for watching, everybody. See you here next time.